Welcome to the Whitwam Wealth Real Estate Podcast. On today's episode, Real Estate Investor Economic Update 2026 Q1.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and on today's podcast, our topic is Real Estate Investor Economic Update 2026 Q1. So we're just going to take some different points about the economy, talk about it, how it affects us as real estate investors, and just get a really good kind of idea of where the landscape is laying right now. I think I've got 5 or 6 points that we're going to talk about. So number one, I think one of the biggest things that we're seeing right now with regards to the economy, whether or not you think the economy is improving or whether you think the economy is still, overheated, high inflation, really depends on where you get your news from. You know, if you're getting your news from TikTok, you're getting your news from other social media plans like, Facebook, Instagram. I'm not saying they're not bad things. I mean, X may be great for getting some news, but it will lean you or your thoughts one way or another. If you're getting your news from CNN, MSNBC, ABC, CBS, you're going to have a certain idea or thoughts about the economy. It's just the reality of it. If you're getting your money from, One Nation, from Newsmax, from Fox News, you're probably going to have a different blend on the economy. But the real thing that we should be looking at as investors, I'm not talking about from the entertainment value as just being, somebody who lives. I mean, you may watch certain things for entertainment value. It makes you feel good. It aligns with your politics. It aligns with your outlook on life. But what we really need to do is kind of go back and look at some economic numbers and find out if what we're hearing or seeing really aligns up with it. And as investors, it's important because we're making large financial decisions, and some of us are making decisions on scale. And we need to know really what the trends are and where they're going. We don't need a political narrative from, the left or the right trying to drive us into some place where the economy is really not going. Let's remember that in the last 30 years, whether it's left or right news media have changed to be much more political than news reporting. So a lot of times they're going to try to build a narrative. And I'm just going to give a case in point, and I'm going to throw CNN under the bus. They're big boys. They can handle it. I saw CNN had put out a post on how the economy was going, talking about how the president is struggling to keep inflation low, and dealing with the economic pressures of having high inflation at 2.7%. Well, it didn't take long, and somebody found a post that CNN did 3 years ago when inflation was running at 9% in some places, 12% in other places. But inflation had pulled back. And they said, even though inflation was, and I think it was at 6 something, whatever it was, even though inflation was at 6.4, they said, well, now it's getting better. It's at 6.0. The economy is getting better. Well, see, this is the kind of thing that shapes a lot of the economy. And I'm not just saying CNN doesn't. I'm saying that, left and right, I've seen it on both sides. The news network, where it can shape people's views. In one case, they said, hey, 6% inflation is good because it's coming down. And another case, they said 2.7% inflation is bad because it hasn't coming down low enough. Now, so when we look at these things, we want to make sure that we're getting the statistical news from places that we can trust. And so I'm going to say kind of burn through the political leaning left or right and try to get good information, because where you get your news from will a lot of times determine your outlook on the economy. Number two, I want to talk about our current economy, because I believe, based on the numbers that I've seen, that we are actually in a growing economy. I guess probably, and maybe I'll do this when I talk about when we get into the Federal Reserve, trying to hit a target rate of 2% interest doesn't make sense in a growing economy. I look at the CPI, the Consumer Price Index. It came in last week at like 1.6%. I looked at the last quarter, and the growth was at 5.3%. I looked at the U.S.-born worker labor force, which is increasing. I looked at real wages and saw real wages have been going up. And so when I look at this, I look at a growing economy. Now, depending on the news network that you listen to and look at and find the information from, you're going to hear good and bad on both sides of this. But I want to look at the numbers. I want to see what is really happening. And from my standpoint, I think we have a growing economy. The one sector that is kind of the outlier in this growing economy that still I would say has the brakes on it is the real estate economy. And a lot of that has to do with interest rates. Though interest rates recently have begun to fall back, and we're back in I would say if you got good credit, you can get interest rates in the 5s. And that means a lot for us as investors, not because we're out looking for necessarily standard or retail mortgage loans for our investment properties. But when the economy starts to grow, when the economy starts to get good, the private money sector and the hard money sector begins to give more favorable terms because it's easier for them to liquidate properties if they do have a foreclosure event, an event they have to take back a property. And so the terms, the amount of down payment that they need, the interest rate, and some of those other factors that play into private and hard money actually start to get better in a growing economy, which I think is where we're at right now. We're actually starting to see the real estate market tick up a little bit. I think that you're going to start to see some home refinance on the mortgage side of things tick up a little bit as we start driving into the lower 5 area. And I don't think I would wait on the Federal Reserve to do anything. I think his battle, the Federal Reserve's battle with the White House right now is pretty strong, and I don't think you're going to see a whole lot of favorable things, though the board could push for some more rate cuts. It doesn't appear that Jerome Powell really has the flavor for those right now. So let's talk about the third thing here, and that is a new Fed. So in May, we're scheduled for a new Federal Reserve appointment. And the two front runners, Kevin Hassick and Kevin Warsick, right now, both have their fingers on the pulse, I think, of this economy. They have a different model than Jerome Powell has. If you remember Jerome Powell, and then before Scott Bessent, when the trend with Janet Yellen was first thinking that the inflation was transitory, and then thinking that pumping more money into the economy through something like a Inflation Reduction Act would actually lower inflation. All of these type of things, I think that you're going to see a change with Scott Bessent, at Treasury, and you're going to see one of the Kevins probably at the Fed. I think you're going to see some new economic outlooks, because instead of looking back, which is what our current Fed does right now. So, for instance, the current Fed will take data from the previous 2 or 3 months, and they will make determinations on lending rates, mortgage rates, the target rate that banks lend each other money based upon where we came from. I think the new Fed is probably going to be more forward-looking. And with forward-looking, I think their interest rates are going to be a little bit more predictive. And in that predictive model, I think we're going to see lower interest rates because the economy is moving to a very big supply side. And because of that, I think that you're going to see costs pull back, interest rates pull back, and the affordability issue begin to disappear. I don't think we're going to get it with Jerome Powell. I mean, Jerome Powell and Donald Trump right now are at loggerheads with pretty much everything. And we can get into all the politics of it, which I'm not going to do here in the show because it's not politics. It's about real estate. But I think that once we hit May, we're going to see a dramatic change, not only in interest rates, but also in the real estate sector. And that's, what affects us. I think we're going to see money be much easier to get. I think we're going to see competition for our flips. I think we're going to see a higher demand for our buy and hold properties. And I think that it's going to lead to some very good economics for us in the real estate investing area. And so I do think that the growing economy is helping us. And again, I just think that once we make some changes at the Fed that match the current financial policy changes, I think we're going to see some benefits for us. Number 4, there's some challenges ahead of us. I know coming into 2025, when President Donald Trump started talking back in March and April about implementing tariffs, it created a lot of challenges. The biggest challenge is it's not what has always been done. It's not the ordinary. It's not the way that it's been done in the past. And because it's not the common way of doing things, it's not the ordinary way of doing things, it created a lot of anxiety and animosity, believing that these were taxes, it was going to lead to inflation. Well, now we're a year into it, and we've seen that it's created giant revenues for the Treasury, which I hope will be used to help pay down the national debt. That'll have to be something that Congress actually makes the decision on. But that it helps bring the national debt back down, get rid of some of the interest we're paying on the national debt, and help free up some money. The administration's talking about rebate checks that would be put out, and these wouldn't be stimulus checks. These would be refund checks, refunding tariff money back to taxpayers. And so, but that can create a challenge too when you start piping that kind of money, which is why I would rather see it come in the form of tax relief or in national debt reduction, because we saw what happens when you overstimulate an economy with dollars, unexpected or free dollars. I think I'd rather have my refund go to paying down the national debt, but that can create some challenges. And I think we're going to have some of these challenges. I think new Fed policy is going to create some challenges. You can't arbitrarily just drop interest rates and expect it to not have any effect. And the effect could be rising home prices again. I'm hoping the Fed takes a little bit metered approach. I was hoping that the current Fed, Jerome Powell, would have done that too. I think he would have avoided some of the challenges that we're facing now, instead of, dropping 0.75 of a point right before an election and then barely dropping any last year. If he would have just started on a trajectory of dropping 1/8 of a point and doing that routinely, I think we'd probably be to the same place we are now, but it would have been a metered drop, and I think it would have helped stabilize the economy and probably brought some of the real estate market back. All right, so number 5, let's talk about mortgage rates, because mortgage rates affect us in this industry. Right now let's just say we're sitting at 6%, maybe the upper 5s when I'm recording this podcast today. Historically, those are low, but we still have an exchange problem. The exchange problem we have with mortgage rates is we still have people with 2.25%, 2.5%, 2.75%, and 3% mortgage rates, and they're still not willing to trade a 3% mortgage for a 5.5% or 6% mortgage. I think we're really going to need to get down the low 5s, the upper 4s, to see a dramatic move from sellers sitting on these low interest mortgages. And once that happens, I think you'll start to see more inventory come into the marketplace. More inventory will help to stave off the rising prices from lower mortgage rates. So as mortgage rates go down and more inventory comes on, we're hoping that the inventory will offset the mortgage rate price rise, so that it'll at least put some stability back into the real estate market for us. I do think that mortgage rates are going to get into probably the upper 4s again. I don't think that we're going to see them as an economy back down 3, 2.5, because the economy is actually good and it's growing. And generally, you're not driving interest rates that low, because low interest rates, though they help the real estate economy and though they help home buyers and they help with affordability, there's a whole segment of our economy that they hurt. Low interest rates hurts our retirees. People with 401ks, people who have money that is invested and they're relying on the rates of return, the interest rates that are being generated from some of their retirement investments. So mortgage rates may drop, but again, there's always a cause and effect in everything in the marketplace. But I do think we're going to have lower mortgage rates throughout probably at least 2027 with the economic outlook. And a lot of it will depend too as we come into another election year, whether or not the current administration is able to hold on to their political control in both houses so that they can continue to implement their economic growth plan. Number 6, this is my last one for today, and that is it's time to act. I really think this is a great time to be in real estate. It has not been a great time, but I think that we're on the precipice, or we're right on the edge of some things happening. We've got a growing economy. We've got inflation that is below economic growth, because I don't care whether inflation is 4%. If wage growth is 10%, people are still making more money. They're generating more money than the costs of goods. And I think we're in one of those times where wage growth is way going to outpace inflation. We saw back in this president's first term how inflation dropped below 2%. I think we're actually going to get there. I think you're going to see some growth numbers in the 5, 6, and 7%. I just think it's going to happen with what we've got. There are trillions of dollars of manufacturing money coming into the U.S. I think that is all going to build on this pent-up buyer frustration. So as properties begin to come on, buyers begin to come back, investors are going to be able to leverage more properties. We're going to have better rate terms with our private and hard money. And then for those who are doing long-term loans, I think, whether it's a DSCR route or whether it's a more conventional, GSE type investor loan product, I think there's going to be some opportunities there for us. So I think this is a time to act in 2026. I think Q1 looks good, and it's starting to shine some light, I think, on how the rest of 2026 will be. That's all I got for today. But if you found this episode valuable, be sure to subscribe, leave us a review, and share this with another investor who could use to hear it. That's all for this episode. So thank you for joining me in this episode of the Whitwam Wealth Real Estate Podcast. Be sure to check out our previous episodes of real estate related investing topics. And I'm glad you're part of our growing real estate community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This has been Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.